Good afternoon. Welcome to today's webinar. As most of you know, my name is Roman Basie. I'm an attorney and CPA, and today's an interesting day, as we all know, because we are anticipating a vote in the Senate on the healthcare replacement bill and whether or not it's going to go forward for debate and open amendment. So we're watching that very closely, and at the time of producing this webinar, we're about 2 hours away from the potential vote that we expect to take place one way or another. I wrote a short blog on that today. You can check it out on our website as well. Again, we're really looking at that as far as what tax relief that the Senate or the House may end up passing. So let's take a look, though. Today's webinar and our monthly topic is on Presidential Order 13789 and its future effect on the tax code. And as you know, we've been following the House Ways and Means Committee blueprint and the blueprint that they put out back in June of 16 on the tax relief that they wanted to present to Americans. And now the president has issued an order and effectively, let's take a look at his order. It was published on April 21st, 2017 in the Federal Register, volume 89, number 79. You can find it online very easily. It ordered the Secretary of the Treasurer to review, quote, all significant tax regulations issued by the Department of the Treasury on and after January 1st, 2016. So the president was ordering our Secretary of the Treasury to look at all the regulations that were passed in that time period. The order went on to state, in consultation with the administration of the Office of Information and Regulatory Affairs, Office of Management and Budget, to identify in an interim report to the president all such regulations that, number one, impose an undue financial burden on U.S. taxpayers, two, add undue complexity to the federal tax laws, or three, exceed the statutory authority of the Internal Revenue Service. The president is trying to promote some tax reform in these three areas of the law. Whatever political side you may fall on, I don't look at it from that angle. We're just saying, look, this is what he's asking the Treasury to do and to look at those. And the policies that they want to be advanced are, they want to lessen the tax burden. And we've heard this a lot, and we've heard a lot about postcard filing. In fact, we've seen a sample now of what they would like to promote as postcard filing of tax returns across the U.S. and how much easier it would be depending upon the bracket that you fall in to prepare a tax return. They want to promote economic growth. And how do they do this? Well, if there's business owners listening today, the one thing that you should know is what is being promoted by the House Ways and Means Committee is a 100% deduction for investment in capital in the business. And we haven't had that before. As we know, we've had the Section 179 deduction and we've had bonus depreciation. Those two things are trying to promote economic growth. But as business owners, you know, those deductions are limited. They're limited sometimes to the price of the capital investment, to the profits that are being produced by the company. And what the House Ways and Means Committee wants and what the executive order wants is to try to make that 100% of a deduction for a business. And then again, unleash businesses from fines and complicated forms and frustrations. A little hard to see that word frustrations on there. So what could be on the chopping block? Well, we know Internal Revenue Code Section 199, which is the domestic production activities deduction, is on the potential chopping block. We may lose this deduction. And to me, this is a very good and very well used deduction with businesses across the U.S. to this day. And we encourage our clients to use this deduction if they're producing something in their company. And it's Internal Revenue Code 199. And look at the comment. Today, the tax code is littered with special interest deductions and credits that are designed to encourage particular business activity. These provisions create incentives for businesses to make decisions because of the tax consequences rather than because of the underlying economics. However, the thought process is that this code section is not utilized very well, and thus it's on the chopping block because it's not understood by a lot of companies across the US. And while that's true, when it is understood properly, it is a good tax deduction. So we are hoping that that is not one of the cases. It's an extremely popular section of the code, again, used by many of our clients. It applies to traditional manufacturers and many broadly defined firms that would otherwise not be considered manufacturers, such as growers, software firms, construction firms, automotive rebuilders. If you are producing a product, you potentially, here in the United States, you potentially have the advantage of using this deduction. And this deduction can be as much as up to 9% of the profits of your company that you can deduct under this particular code section. So if you have any questions about that, contact our office. I'll talk you through that section. We'll see if that's something you can use. One thing we'd like to do if you contact us and say, Roman, I'm interested in learning more about that code section in particular, one of the things to do is to take a look at the tax returns you've filed for the last 3 years. And this particular code section, sometimes we have to look at your personal tax returns. I want to point something out today, too, that's interesting this morning and expecting this vote this afternoon. One of the things about this vote, and we talk about this vote today, even though it's the healthcare bill, there are 2 tax provisions that we're watching very carefully. And it relates to this topic today, too, with this presidential order and what sections of the code that he's looking at. The healthcare bill today is asking to open up the healthcare bill for debate and open amendment. The first amendment the Senate says that they're going to present is a full repeal of the Obamacare bill, but that repeal will not take place for 2 years. So let's relate that to what we're talking about now. If we look at tax reform potentially that we may see in September based upon this presidential order and the House Ways and Means Committee's blueprint, if we start to see tax reform come out in September, are we looking at the same thing? Are we looking at a 2-year waiting period for some of these tax provisions to be changed? It's very possible. It's very possible. Another potential tax on the books that became another identifiable issue in the presidential order and the preliminary report that we have now is the earned income tax credit. The blueprint states the IRS makes billions of dollars in improper payments through the programs it administers. At 24%, the earned income tax credit has the highest level of improper payments of any federal program, nearly $15.6 billion in improper payments in fiscal year 2015, nearly double the rate of the next highest program. If you're a tax return preparer and you're listening to our webinar today, if you're preparing tax returns and you're utilizing this earned income tax credit for your clients, or maybe you're someone listening that takes the earned income tax credit, you've got to be very careful. This is a very big red flag now for the IRS because of how bad the double checking on this program has been for them. So keep that in mind too. We know tax reform will come. The executive order and the House Ways and Means Committee's blueprint means that tax reform will come. We will have an impact on transferring businesses across the U.S., and it's very, very possible that we will have more favorable tax rates in the near future. Follow our tax blog. The preliminary report on this executive order is out there now. It has been published. It is out there. And I identified some of the few tax provisions in our blog that the Secretary of the Treasurer is saying will be in their final report. We anticipate their final report in September, along with the House Ways and Means Committee's first draft of a new tax bill. Now we anticipate in September, as that is what they've told us. So, and there is our next webinar will be Thursday, August 24th, why it's important to have a qualified specialist handle estate planning. There has been brand new tax court cases out that have explained why it is important to have a qualified specialist handle your estate tax planning. And there is my contact information at the Center for Financial, Legal, and Tax Planning. There's our email. There's our website. Feel free to contact us. We'd love to hear from you. Thank you.